Okay, so here we go with an example in which you have a parent entity and they have a foreign subsidiary. Okay, so let us work through this example to understand how exactly we're going to first of all translate the foreign subsidiary financial statement into the presentation currency, nothing but the parent's currency. And then you got to prepare a consolidated financial statement, that is balance sheet and profit and loss statement. Okay. So, let's go ahead and read the question. Yes, Renuka.
Parent is an entity that owns 80% of the equity share of overseas. A foreign entity that has its shillings as its functional currency.
Okay.
So the subsidiary was acquired at the start of the current accounting period on 1st January 20x7 when its retained earnings were 6,000 shillings.
Mm-hmm.
At that date, the fair value of the net assets of the subsidiary was 20,000 shillings.
Okay.
Now, this included a fair value adjustment in respect of land of 4,000 shillings that the subsidiary has not incorporated into its accounting records and still owns.
Okay.
A goodwill which is unimpaired at the reporting date is to be accounted for using the full goodwill method.
Okay.
At the date of acquisition, the non-controlling interest in overseas had a fair value of 5,000 shillings.
And
then statement of financial position is given.
Nothing but the balance sheet, okay? As a 31st December 20x7, right?
Yeah. So investment.
So they're given, I think they're given 3 columns, right?
Yeah.
That is particulars, then you have the parent, which is in dollars, and then you have the subsidiaries information
overseas in shillings.
In shillings. Yes, ma'am.
Investment 20,999 shillings. Under parent $3,818.
Okay.
Then assets parent $9,500. Then overseas 40,000 shillings. They made a total. Then equity and liabilities. Equity capital $5,000 for parent and 10,000 shillings overseas. Then retained earnings $6,000 parent and 8,200 shillings overseas.
Okay.
Then liabilities $2,318 and 21,800 shillings overseas. Then statement of profit or loss for the year is given. Revenue for parent is $8,000 and for overseas it's 5,200 shillings.
Okay.
Then cost $2,500, 2,600 shillings. Profit before tax is 5,500 and 2,600. Then comes tax $2,000, 4,400
shillings.
Then profit for the year is $3,500 and 2,200 shillings.
Okay.
Then neither entity recognized any other comprehensive income in their individual financial statement during the reporting period.
Okay.
Then relevant exchange rates are given. Date on 1st January 20x7. Shilling per dollar is 5.5. Then 31st December 20x7, 5. And average for the year to 31st December 20x7 is 5.2.
Okay.
Then requirement. Prepare a consolidated statement of financial position at 31st December 20x7 together with the consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 20x7.
Okay, so this can come for 15 marks in your examination. So here you have been asked to make a consolidated balance sheet, nothing but SOFP, statement of financial position. And also make a consolidated statement of profit or loss and other comprehensive income. Okay. Okay, so how do you go about consolidating a foreign subsidiary? No, you just follow these working notes. Now just see the first working notes out there. What is the first working note you got to?
Group structure.
Exactly. So we know very clearly that the overseas is supposed to be the foreign subsidiary. In that, the parent entity owns how much? 80%.
80%.
That means the non-controlling interest is 20%. So that will be, you just have to put a diagram out there if you want to. Otherwise, simply write parent entity having 80% control over overseas. And NCI how much? 20%. That's it with working note 1. Now, working note number 2, what do? They made 3 columns. Okay, you don't have to do that. You just make 2 columns. That will suffice. The column heads the particulars and the second column what? Net assets on acquisition date. So how to calculate the net assets of the subsidiary company on acquisition date? You can consider the share capital as on that date and then add, what is that? You can add the retained earnings, okay, as on acquisition date. So now tell me, what is the share capital given on the balance sheet overseas at the year end?
10,000.
10,000 shillings. Now, since there's no fresh issue, see, 10,000 is appearing out in the balance sheet as on 31st December 20x7. So, since there's no fresh issue made by the subsidiary in the current year, would have been there at the start of the year also, right? So, share capital 10,000 shillings. Remember, just see as I speak, just refer to only the 2 columns, particulars and the net assets at acquisition date. Now, I don't want the third column at all. What is that? Net assets at the reporting date. Okay, just ignore that column. So, under particular share capital, that is equity capital, how much? 10,000 shillings. And then retained earnings as on that date, how much? It is 6,000 shillings. That's given the question. That is, a parent bought 80% interest in subsidiary on 1st Jan 20x7 when the overseas subsidiary had a balance of 6,000 shillings in retained earnings. So that is your pre-acquisition retained earnings, $6,000. And plus another, that is a $4,000 fair value increase in, what is that?
Land.
The land appearing on the balance sheet of the subsidiary, right? Property, plant, equipment. So what is 10,000 plus 6,000 plus 4,000?
20,000.
I think the 20,000 is already given the question, right?
Yes.
The 20,000 is a fair value of net assets on acquisition date given. Now this 10,000 shilling share capital, 6,000 shillings of retained earnings, and 4,000 is a fair value adjustment. Okay, land, the land's value is 4,000 shillings more than the book value as on that date. So in all, 20,000 is supposed to be the fair value as on acquisition date, the fair value of net assets of the subsidiary on acquisition date. And I need this number to calculate the goodwill arising on acquisition, right? But what I do is say I don't have to make the third column at all. What is done out here? Okay, I don't need the third column. But one thing you can write in working note number 2 after the start, if you want, you can put a small note, okay, saying that post acquisition retained earnings. Nothing but what? The profit made by the subsidiary since the shares are bought by the parent entity in the subsidiary on 1st January 20x7. The entire profit made in the current year is what? Post acquisition profits. Now tell me, what is the profit in the statement of P&L, Renuka? Under overseas. So you can
profit for the year 2002.
You can either take that straight away, or what you can do is go to the balance sheet. What is the retained earnings given under overseas at the year end? Is 8,200 shillings. But what is the opening balance? That means what? 2,200 shillings is a profit made by the subsidiary in the current year, which is all post acquisition. Understood?
Yes.
So 2,200 shillings is all post acquisition retained earnings. You leave a note in working note number 2 till after finding out the net assets on acquisition date as 20,000 shillings. You can write a note below saying that the post acquisition retained earnings is equal to, you can write the year end 8,200 shillings minus what was there on acquisition date 6,000 shillings. So difference how much? 2,200 is a post acquisition retained earnings. Is that fine? In shillings. That's working note 2. And now comes the most interesting part. What is that? How do you calculate the goodwill? And very important, the goodwill should be translated, should be retranslated at the year end as well. Okay, now check this. Working note number 3. What is that? It is a goodwill. Okay. In that working note 3, first let's ascertain the goodwill in what? In shillings. Now, what is the first line? We write the fair value of the consideration that is paid by the parent company to buy that 80% interest. I think that is there in the question itself as a 20,999 shillings. But it's also given in dollars, okay, after conversion. So, but anyway, you take 20,999 shillings, take that. And then to this, add the fair value of non-controlling interest because they say full goodwill method, okay. And they want a fair value NCI. What is the amount? 5,000 shillings. Adding both, 25,999. And then from this, you subtract the fair value of the identifiable net assets acquired by the parent, right? Or net assets as at acquisition date, I should say, right? Not acquired. As at acquisition date, which is 20,000, right? So, net identifiable assets of overseas is $20,000 as determined in working note. Working note number 2, and this number is also given in the question. Now, if you balance, you get a goodwill of 5,999 shillings. Now, most important, this goodwill will be shown in the balance sheet on 31st December 20x7. In dollar terms, you have to show. For that purpose, you have to translate this amount at the closing rate of exchange. And that is the rule. You have to translate all assets and liabilities of the subsidiary company, including any goodwill arising in business combination, at a closing rate of exchange. At closing rate of exchange. This is what? 5 shillings equals $1. So what is 5,999 by 5? Which is equal to $1,200. And that is the amount to be shown in the balance sheet as goodwill. But point to note. So what would have been the goodwill in dollar terms on acquisition date? And that should be compared with this $1,200 and find what is the translation reserve or gain, right? Or retranslation of goodwill. Remember this 5,999 shilling goodwill arose when? On 1st January 20x7, right? Even though it is reported at the year end also in your balance sheet, I translate at 5 shillings equals $1. Now just see they made one more table you got to make in working note 3. Now what is first line? It is goodwill at acquisition. That's the truth. So in shillings is 5,999. And what was the exchange rate a year ago on 1st Jan? 5.5. 5 shillings equals $1. So what is 5,999 by 5.5?
1,091.
Exactly, $1,091. And then less any impairment, right? If there is an impairment, what you should do, you take the impairment of goodwill in shillings and the exchange rate will be, you take what? The average rate. Because impairment, something happens during the year, right? So you can take an average rate. What is the rate given? 5.2. But in this sum, anyway, there's no impairment, right? Not impaired. So forget about that. Then comes the exchange gain, balancing figure, leave it blank. Then you go to the goodwill at the year end. How much? 5,999. The exchange rate of 5 shillings equals $1, which is 1,200. What happened? The $1,091 goodwill has become what? $1,200 because of exchange rate difference. And that increases an exchange gain of how much? $109. Of this, 80% belongs to whom? The parent entity. We say the group, right? And then 20% belongs to whom? NCI. Now people ask you, why do you split the goodwill 80-20? The reason is what? It's a full goodwill approach. That means even the NCA has been taken at fair value. Suppose, let us say NCA wasn't fair value. It's not full goodwill, it's partial goodwill method, where I measure NCA at proportion net assets, okay, which you must have done in a lot of sums and consolidation. In that case, the entire exchange gain will be added to the group, okay, belongs to the parent and not to the NCA. But here, since it's full goodwill method, that is where the non-controlling interest has been measured at fair value. The goodwill, the exchange gain on retranslation of goodwill belongs to both the parent, that's a group, okay, share, the parent entity shareholders, and the non-controlling interest, right? So what is 109 into 80%? It is $87. Okay, belongs to the parent entity, the group. And then 20% of 109, which is 22. Or 109 minus 87, $22, right? NCA. And with that, you complete working note 3. Working note number 4 is what we normally do, non-controlling interest. That is, I want the NCA to be shown on the balance sheet as on 31st December 20x7. That's very simple. Now what I do is, I take the non-controlling interest as on acquisition date, which is 5,000 shillings, right? And divided by 5.5 on acquisition, that is exchange rate. 5.5 shillings equals $1. How many dollars you get, ma?
$909.
Take that and then add 20% of the post-acquisition retained earnings, and also take the non-controlling interest share in the exchange gain arising or retranslation of goodwill, right? What is the next line shown, ma?
There's NCI of post-acquisition.
Nothing but we know post is 2,200 shillings, right? Subsidiary. That divided by 5.2 because average rate, profit for the year by 5.2. And whatever number you get on that, apply 20% is a non-controlling interest share. How much you get, ma?
$85.
Is $85. And then also add
NCI share of exchange gain.
Exchange gain.
Cancellation of goodwill.
Which is $109 into remember 20%. And that is 21.8 or round off to what? 22. Add 22. Add up all the 3 numbers and that is a non-controlling interest to be shown in the balance sheet. How much?
$22.
That's after adding all the 3.
After adding, I get $1,092.
That's it, right?
No, we have one more. No, that
we have that is one more. That is I'm really sorry. There's one more. But you need to for that to get the NCA share in what? In the exchange gain arising on translation of the foreign subsidiaries balance sheet, right? For that, we have to go to working note 7. You can keep this pending. You can keep this part pending. What is that? That is adding 20% of the exchange gain arising from translation of the net assets of the foreign subsidiary into the presentation currency, right? So let's wait for this number. Let's not even put this number, okay? But there's one more line item for NCI. And let's open working note 6 as well. Just say retained. Working note 5 is what? Retained earnings, right? 5 is retained earnings. Working note number 5, retained earnings. What does it show? That is retained earnings of there's nothing but what? What is retained earnings to be shown in the balance sheet, right? That is in your consolidated balance sheet. Under that first,
parent $6,000.
the parents retained earnings given in the balance sheet, okay, as on December 31st, $6,000 given. And definitely add what? It is the parents 80% of the subsidiaries of post-acquisition retained earnings. So 2,200 shillings divided by 2 into 80%. How much?
$338.
338. And then you go to, what is that? Add.
Add both $6,338.
Okay, that's it.
That's it.
Okay, then next.
Translation reserve.
Now comes a translation reserve. Okay, how to find that? Yeah, read.
So group
It
share of
is,
goodwill forex.
For completing working note number 6, I need to do working note 7. What you'll do, we'll first go through working note number 7 and then go back and complete what? Working note number 4. Remember, still hanging NCA. We'll complete that and then complete working note 6. Take us to working note 7.
So forex on
This
net
is how
assets
you're going to calculate the translation, we say the translation adjustment, FCTR. You say foreign currency translation reserve. Okay. You call it FCTR. Nothing but basically it's an exchange difference arising from translation of the foreign subsidiaries balance sheet, right? All the foreign currency items on the balance sheet into the presentation currency. Yes, this is how you do it. Okay. Now, what is the first line?
net assets at acquisition.
Net assets at acquisition date. Against that?
20,000 shillings.
20,000 shillings, which includes even the 4,000, right? Increase, right?
Exchange
So
rate
20,000
is 5.5
rate is 5.5.
and 3,636.
This is the net assets at the start of the year. And add what to this?
Retained
The profit for the current year, right? The profit for the current year, retained earnings increase. How much? 2,200
200
shillings. The exchange rate 5.2 average rate. And what is the amount?
$423.
$423. Okay, so if you want, you can add up these two numbers. That is in dollar terms. In dollar terms, what are the two numbers, ma?
$3,636
Plus.
423.
If you want, you can add up these two and say that is supposed to be. That is supposed to be the net assets at the year end. But the point is, the net assets at the year end will be translated which rate at the closing rate of exchange. Instead of translating each and every asset and liability, you can translate what? The net assets. Now, what is the net assets of the subsidiary at the year end?
22,200 shillings.
How do you get 22,200? Please refer to the balance sheet of the subsidiary. Okay, go to the question mark. Refer to the subsidiary's balance sheet. Now, what are the assets on the balance sheet? What are the assets on the balance sheet one by one?
There is an investment.
Nothing
is there. Yeah, assets 40,000.
Just $40,000, 40,000 shillings given.
Shillings.
And then what are the liabilities?
10,000 equity capital, 8,200.
No, I want liabilities.
Only liabilities 20,000, 21,800.
So what is 40,000 minus 21,800? 40,000 minus 21,800 works out to 18,200. But remember, there was a $4,000 increase in the value of land. Therefore, the truth is it is not $40,000 asset. It should be 44,000. Yes or no?
Yeah.
It is 40,000 shillings given, not dollars, 40,000 shillings given. But please remember that 40,000 includes a piece of land which was fair valued and there's a 4,000 shilling increase. It is actually 44,000 minus 21,800. So that is why the closing net assets are 22,200 shillings. Is that fine? It's 22,200. Or in other words, go back to working note 7. What is the opening net assets? 20,000, which includes a 4,000 increase, right? What is the retained earnings for the year, profit for the year? 2,000. Adding both how much?
22.
Exactly. The same thing, right? You should not get confused when you see the balance. That's why I went to the balance sheet. Just to tell you that 44,000 minus 21,800. Is that fine? So 22,200 at a $5, 5 shillings a dollar. How much you get? 4,000?
440.
Now what? Tell me. So what is the total you got earlier? Adding 3,636 and whatever, 4,000?
423, not 4,000.
No, no, no.
4,059.
4,059, right? 4,059 has now become 4,440, right?
Yeah.
So what is the exchange gain?
381.
That is an increase. That is an increase in net assets in dollar terms because of exchange rate fluctuation, right? So that is a $381 gain. Of this gain, remember 80% belongs to the parent entity and 20% whom? The minority or non-controlling interest, right? Because at the end of the day, the net assets of the subsidiary is controlled by whom? The parent entity 80%, balance what? NCI 20%. Now you go back to NCI step number 4. In that, just see. The first line we saw 5,000 divided by 5.5, and then retained earnings 2,200 by 5.2 into 20%, and then add
the exchange gain
on goodwill. How much? 22. Also add NCA share.
Exchange gain on retranslation rate assets.
Exactly, $381 into 20%. How much, ma?
$76.
Adding up all, how much you get?
$1,092.
And that is your non-controlling interest to be shown in the balance sheet. Is that fine?
Yes.
Now let's go to working note number 6. Nothing but what is the amount to be shown as FCTR on the balance sheet that belongs to the parent entity? Got it? So under translation reserve adjustment, that is no working note number 6. You can take $381 into 80%. How much?
$305.
And also on goodwill, right? Remember $109 into 80%. How much? 87. Adding both?
$392.
That is the amount to be shown in the balance sheet as other equity. Under other equity, you show retained earnings. What is there in working note number 5? And the translation reserve, FCTR, or we call that as a cumulative translation adjustment, CTA. Is that fine? So adding both. Now tell me working note number 5, what is the retained earnings, ma?
Working note number?
Number 5, $6,000 plus.
That's $6,000 plus $338.
$6,338. And how much you got in working note number 6? The total. That is $381 into. Adding both the numbers will be added and shown under the heading what? Other equity in your balance sheet. Is that fine? So that is all with all the working notes. Now we shall go ahead and prepare the consolidated balance sheet of the group. Yes, ma'am. The group balance sheet.
Yes, financial position.
Nothing but balance. You write balance sheet. Okay, in the exam you should write balance sheet, not financial position. Yes.
So goodwill as per working note 3.
Very good. $1,200. What you got? Okay. Next.
Then assets.
Then assets will be the assets of the parent will be shown in dollars as it is. What is the amount?
$9,500.
$9,500 plus
40,000 shillings plus 4,000.
In all 44,000 shillings divided by
5
shillings each dollar.
$18,300.
That's it.
Adding $19,500.
$19,500. Okay, next.
Equity and liability, equity capital $5,000.
How much is equity capital?
$5,000.
It is $5,000. And we all know that only the parent company's share capital is shown. Okay.
Yeah.
Then what happens? The next 2 items in your exam you can show under other equity heading. Which one? The retained earnings of 6,338 and translation reserve
392.
These 2 can be added and shown as other equity in the balance sheet. Then comes non-controlling interest.
1,092.
Exactly. What you got in working note number 4. And then comes liabilities.
Liabilities.
What is the parent's liability?
2,318.
As it is, it will be taken.
Yes, 21,800 shillings divided by 5.
5. And add both, and that is the amount to be shown.
$6,678.
Is that fine? And that is all balance sheet done. Now we go to the statement of profit or loss and other comprehensive income. In that first, you take Revenues, you can take the parent revenue in dollars as it is. But subsidiary, what you do, translate at 5.2, the average exchange rate. Okay, 5.2. And less cost the same way. Take the parent's cost as it is in dollars. And then for subsidiary at 5.2. And you get profit before taxation.
$6,000.
And then less your income tax also, you take the parent's income tax as it is in dollars. And for subsidiary, translate at 5.2, right? Average rate. And then balance, you get
$3,923 profit.
Profit for them. But remember, this 3,009, how much?
20.
This, okay, you have to split this between whom? The parent entity and NCI. But don't take 20% of this amount. This amount includes what? Even the profit made by the parent entity on its own. Okay. You can take 20% only on the profit made by the subsidiary. Very important. Anyway, now we start with other comprehensive
Income.
Under that, remember, you should all know by now. Okay, people writing the May 22 examination, OCI. In OCI, we classify the items. Example, there are certain items that will be reclassified to profit or loss. And there are certain items shown under OCI which cannot be reclassified. But please remember the foreign currency translation reserve or the exchange difference arising on translation of foreign subsidiary, the balance sheet, is an item which can be reclassified to profit or loss. Suppose the parent is going to dispose of their 80% interest in subsidiary later. Then whatever amount they have in FCTR can be taken to profit or loss. That is why they given the heading, right? Items that will be reclassified
to profit or loss
in future periods. Okay, when parent is going to dispose of the subsidiary. Under that we have
exchange difference on translation of foreign subsidiary,
which is $381.
$109
plus 109 arising from goodwill, right? In all, how much?
$490.
Because even goodwill is taken as an asset of a subsidiary, that's why it's translated. Fine. In all, $490. Then adding was a total comprehensive
income. For the period.
Now what I should do?
$413.
Okay, now what I should do? I should find the profit for the period is 3,000, how much?
838.
That should split between NCI and parent.
Oh no, 3,923 split between owner and.
But not the straight away the total amount. Don't take 20% of that. Okay, you should take only the profit made by the subsidiary company, and the 20% of that post acquisition. I think which is already shown as $85, right?
Yeah.
That 85 is already shown in working note number, if I recall, working note 4. Remember 2,200 divided by 5.2 and that into 20%. Anyway, now read what is given.
So profit for the year attributable to owners of parent.
Owners of parent, a balancing figure. Next line.
Non-controlling interest is 20% of 2,200 shillings divided by 5.2.
2,000 profit. 2,200 profit reported by the subsidiary. By 5.2, you get the number of dollars. On that 20%, how much? 85. So what is the balance?
$3,838.
That is all. Then comes a total comprehensive income. Even that is split between whom? The parent and the non-controlling interest. Yes, ma. Total.
So total comprehensive income attributable to owners
of parent entity balancing figure.
Non-controlling interest is $85 profit plus
the $85 profit we already have. Remember the $109 and how much? The 381. Remember that 20% of that. That is $76 and $22, right? So 85 plus 76 plus 22, how much, ma?
$183.
That's NCI, and balance will be
$4,230 parent.
That's all done. With that, you're done with this example. A very important